You're watching gold prices right now. Maybe you own some. Maybe you've been thinking about it. But here's what almost nobody is saying out loud. The setup for gold's next move is unlike anything we've seen in the last 2 decades. And the shocking part? Most investors are completely unprepared for what comes next. Stay with me. Let me ask you something. When was the last time you felt confident about your money? Really confident. Not just hopeful. Not just trusting that the system works. Actually confident. For most people, that answer is uncomfortable. Because if you've been paying attention over the last few years, confidence has become a luxury most of us can't afford. You've watched your purchasing power shrink. You've seen inflation labeled transitory and then stay for years. You've watched central banks promise one thing and do another. You've seen interest rates jump, bonds crash, real estate stall, and the dollar do things that should be impossible. And through all of this, gold has climbed, higher and higher. But here's what's really messing with investors right now. The climb hasn't felt that dramatic on the news. Wall Street talking heads have downplayed it. Your friends probably haven't noticed. And that makes you feel like maybe you're overthinking this. Maybe gold is just going up because people are scared. But that's only the surface explanation. Here's what most people miss. Gold isn't just going up because people feel nervous. Gold is moving because of something much deeper, something structural, something that's forcing a massive shift in how central banks, governments, and smart institutional money are behaving right now. Let me break down the real mechanism. Step 1. For decades, the US dollar was backed by something very simple: trust. Trust that America would stay fiscally responsible. Trust that the Fed would manage inflation. Trust that the currency would hold its value. But something has changed. The US government is now running deficits that would have been considered fantasy numbers just 15 years ago. We're talking about over $1 trillion in deficit spending per year. Not temporary, not cyclical, structural, built into the system. At the same time, the Federal Reserve is trying to fight inflation by raising interest rates. And when you raise rates, you make it more expensive to service that debt. So the government has to borrow even more, which pushes rates higher, which makes the problem worse. This is the trap. Step 2. Other countries started noticing this trap, really noticing it. Central banks around the world used to pile up dollars. American dollars were the global reserve currency. Safe, stable, everyone wanted them. But over the last few years, something shifted. Central banks started selling dollars. And buying what instead? Gold. We saw this acceleration starting in 2022, and it's only intensified. Russia stopped holding dollars after sanctions. China stopped buying treasury bonds and started buying gold instead. India, Turkey, Poland, and dozens of other central banks all moved in the same direction at the same time. This wasn't coordinated. It was organic. It was survival instinct. Step 3, and this is critical. When central banks start dumping dollars and buying gold on a massive scale, it signals something profound. It signals that the people who actually understand the global financial system no longer believe in the stability of that system. They're not betting against America militarily. They're not making some political statement. They're protecting their country's reserves. They're asking themselves, what will still have value when the current system recalibrates? And the answer, for 5,000 years straight, has been the same: gold. Now, you might be thinking, okay, central banks are buying gold. That's interesting. But why does that matter to me? Here's why. When central banks move, they're moving ahead of the general public. They're moving ahead of retail investors. They're moving ahead of the news cycle. Central banks have access to intelligence, data, and long-term thinking that most of us don't have. When they start accumulating gold, it's not because they're being cute. It's because they're preparing for something. History shows this pattern again and again. In the 1960s, the Bretton Woods system was supposed to last forever. Countries were supposed to be happy holding dollars because those dollars were backed by gold. Except the US government kept spending money it didn't have. Deficits grew. Smart central banks started converting their dollar reserves into gold, just in case. By 1971, the system broke completely. President Nixon closed the gold window. The dollar crashed roughly 40% against other currencies in real terms over the next decade. The central banks that had converted to gold early, they protected their wealth. The ones that waited, they got crushed. In the 1970s and early 1980s, inflation spiraled out of control while governments tried to deny it was happening. Gold went from $35 an ounce to nearly $800. But it didn't happen overnight. There was a pattern to it. People who saw the structural problem early and moved into precious metals protected themselves completely. People who waited for certainty got caught in a rush. In the 2000s, right before the financial crisis, central banks were still the largest players moving money around. And where were they putting it? You guessed it, gold. While everyone else was buying mortgage-backed securities and thinking housing was going up forever, central banks were stacking gold. They knew something didn't add up. This is the pattern. Central bank gold buying precedes major currency and macro recalibrations, and this is where everything changes. Because the current setup is actually worse than any of those historical moments. Right now, we have several things happening at the same time, and that's what makes this dangerous. First, government debt is at levels that aren't sustainable long-term. We have unfunded liabilities in Social Security and Medicare that dwarf the official debt number. We have interest payments on the debt rising exponentially as rates stay elevated. This isn't someone's opinion. These are just math problems. Second, the Federal Reserve has been hinting that interest rates might stay higher for longer than originally expected. Why? Because inflation still isn't going away the way they predicted, and if rates stay high, the cost of servicing the debt stays high, which forces more borrowing, which keeps the system under pressure. Third, and most people miss this entirely, the Federal Reserve's balance sheet is shrinking. They're letting bonds mature without replacing them. This is called quantitative tightening. It removes liquidity from the system. Less liquidity usually means higher prices for safe assets like gold because people become more defensive. Fourth, there's genuine geopolitical risk in ways we haven't seen in decades. You've got tension in the Middle East. You've got the situation in Ukraine. You've got the US and China in a genuine economic and strategic competition. This isn't going away. And when geopolitical risk rises, guess where money flows? Not into stocks and bonds, into hard assets, into gold. And fifth, there's something happening in the institutional money space that most retail investors have no idea about. Gold ETFs that track physical gold have been seeing record inflows. Insurance companies have been increasing their gold holdings. Pension funds, which used to own almost no gold, have been adding to their positions. BlackRock, the world's largest asset manager, has recently been highlighting gold's role in portfolio protection. This is how you know something is shifting. When the biggest money in the world starts moving in the same direction quietly, it's not because they're panicking. It's because they're rebalancing towards something more stable. So what happens next? This is the question that actually matters. Here's the timeline as we understand it. In the near term, gold will likely continue to experience volatility, but with an upward bias. We could see pullbacks. We could see times where it feels expensive and people question whether the rally is overdone. That's normal. That's how markets work. But the longer-term pressure is upward because the structural problems aren't being solved. They're just getting worse. As we move through the next year or two, one of several things could happen. Interest rates could come down because the economy weakens, and the Fed is forced to cut rates aggressively to prevent a crisis. If that happens, gold typically rallies hard because lower rates mean the opportunity cost of holding gold drops. Or, we could see persistent inflation, which keeps rates elevated, which stresses the system further and also benefits gold. Or, we could see a dollar crisis where people lose confidence in the currency itself. That's the most extreme scenario, but it's the one that central banks seem to be preparing for. In that case, gold doesn't just go up. Gold goes up a lot. What the smart money is watching right now is something specific, the point at which the general public realizes that the monetary system is truly in trouble. Right now, that realization hasn't hit mainstream consciousness. But when it does, when regular people start asking themselves, should I be holding less dollars and more gold? That's when you see the real acceleration. This is not hysteria. This is not conspiracy. This is just what happens when a currency loses credibility. So what are the specific signals you should be watching? First, watch the gold-to-dollar ratio. When central banks are moving aggressively, this ratio usually widens. Gold goes up while the dollar weakens. If this ratio starts accelerating, it's telling you that major players are losing confidence in the currency. Second, watch silver. Silver is about 90% industrial use and 10% currency use. But when fear of currency really sets in, that 10% becomes huge, and silver rallies out of proportion to gold. If silver starts spiking while gold is already rising, it's a warning sign that people are moving beyond just defensive positioning into genuine currency fear. Third, watch the yield curve. When long-term interest rates start falling while short-term rates stay high, it usually signals that people expect economic problems ahead. And when they expect economic problems, they move into gold. A steepening curve in that direction is a signal. And fourth, Watch central bank reserve accumulation. This data is published quarterly. If central bank gold buying accelerates from here, we're truly in a new phase of monetary uncertainty. Here's what this all means for you. Most investors are still playing the game as if the current system will last forever. They're allocating to stocks and bonds in the same way their parents did. They're trusting that inflation will moderate, that debt will be managed, and that the dollar will stay strong. Maybe they're right. But the people who actually manage the world's wealth and the people who actually understand how monetary systems work are already moving. They're already preparing. They're already ahead of this story. Gold isn't going up just because people feel scared. Gold is going up because structural change is coming. The kind of change that happens maybe once or twice in a generation. And if you're not at least thinking about gold's role in your portfolio right now, you're betting that all of those central banks, all of those large institutions, and all of those structural problems are wrong at the same time. That's a bet that history suggests you shouldn't make. The real opportunity in front of you isn't to get rich off gold, it's to not get poor without it. The next few years are going to be incredibly important for how the global monetary system recalibrates. Gold isn't insurance against collapse, it's insurance against the certainty that the current system will change. And change, by definition, is disruptive. If you want more deep market analysis like this, where we look at what the smart money is actually doing before it hits the headlines, subscribe and stay close. Because when things change, they change fast. And you want to be watching.